Well, the major indices are rising as October's cool inflation print marks an important milestone for the Fed in its fight against inflation. Investors are now betting on a 100% chance that the Fed will hold rates steady in December. So how can we expect this report and other upcoming data to impact markets? Well, joining us now is Dan Griffith, Huntington Private Bank Director of Wealth Strategy. Good to see you here. So you have this bumper day here. I know that in your notes you talked about, a catalyst for the markets outside of earnings. Does this do it?
I think it's definitely one of the things we've been looking for, which is that signal from the Fed that they were probably going to be in a good position. And we've been holding our breath to see when the market was going to take off. When the Fed was ready to give us that signal, the market was ready to go. And there's a lot of good fundamentals out there to suggest that there's a lot of support for the market growing a little bit, not just kind of the Fed's action, but a lot of good fundamentals as well.
Dan, we have seen inflation coming down, though, for several months now. I mean, what is it about this print specifically? What is it that you're seeing there that gives you confidence the Fed will, in fact, pause, at least through year end?
Well, I think a lot of the fundamentals we mentioned before go back to the conversations we're having with a lot of our clients specifically. Huntington is a company based in the Midwest, and as a result, we get to talk to a lot of business owners who are based in the heart of the country. We recently finished a study with them where we asked them how they were feeling and what they were concerned about. More than 57% of them said that they were very optimistic. More than 60% of them said that they've had a better year this year than before, and only about 8% of them put themselves in a really negative position. I think that conversation informs a lot of what we're looking at, because it is a good way to look at how supply chains and inflation and all of the other factors we just were mentioning before are affecting real business owners and the real consumer as well.
And Dan, of course, we're getting a fire hose of data, not just from Fed speak. We're going to be getting a lot more inflation data, jobs payrolls as well. But I noticed there are 5 numbers that you said that you're watching for when it comes to looking at recession expectations versus a soft landing versus inflation into 2024. I know that year-over-year CPI at 4% was one of them. Break down some of the other ones that you're looking at here.
Yeah, that's right. Obviously, we're looking at some of the other core numbers that are important, making sure that the jobless numbers stay below $300,000 as a key number. And we are starting to see that number tick up a little bit as far as continuing jobless claims. So we are watching that as something to be at least a little cautionary and careful about. We're also looking for a 4% year-over-year CPI, 5% Fed funds rate, which we think, again, as we mentioned before, we think the Fed will probably continue to pause here and not go up a little bit. And we also think making sure that the S&P stays above 4,000. And today is definitely a demonstration of the fact that it's got 4,000 well in the rearview mirror, it seems like.
Dan, I want to get back to those comments you mentioned about business owners that you've been speaking to, because that really is kind of the pulse, right? Where the consumer sentiment is, the business sentiment is. What are you hearing about the biggest concern right now with where things are? I mean, we keep talking about this disconnect between where consumers are spending, what they say or how they say they feel versus what they're actually doing in action. What are you hearing from business owners?
I think a lot of business owners are concerned about, the consequences of the credit market. If you think about the work that the Fed has done over the last 2 years in raising rates and all the other work that obviously they've accomplished, even though all that's happened, many people still haven't really felt the consequences of higher interest rates. If you haven't bought a new car in the last 2 years, if you haven't bought a new house in the last 2 years, if you haven't had credit card debt that you've needed to finance in the last 2 years, then those higher interest rates really are just something you read about or listen to in places like Yahoo Finance. So as a result, it's not something that you feel in real time. I think a lot of our business owners now are starting to see consumers who are beginning to pay those bills, and business owners themselves financing expansion are starting to do that. Many of our business owners, well over half, also said that they have plans for expansion for their business. Much of that expansion also involves the use of credit, and so it's one of those things that business owners are concerned about as well.
So then going into 2024, if you're mentioning that some of these effects still haven't hit, as a lot of people, staying in their homes, not taking on a bigger mortgage, then at what point do you think reality is going to set in, especially for some of these small businesses?
Well, it's going to be a tough one. I think we've been very optimistic as to the potential for a soft landing. We put the risk of recession all last year at about 55%. I think a lot of the other prognosticators out there were a little more pessimistic than we were. And it's interesting, we're still at 55% as far as a risk for a slowdown next year. And a lot of people have kind of come back to the position that we've been in. Again, I think that position is informed by the business owners in our part of the world that we talk to every day. But I think we will start to see that slowdown, mid-year, if anything. We also don't think it'll be a very deep slowdown, and we think that the opportunity for a soft landing is still very solid.
So, Dan, you're expecting a soft landing. You're expecting the Fed to pause. With those conditions in hand, how do you advise your clients? What do they do with their money?
A lot of them right now are asking about fixed income, and of course, today we saw the 10-year yield, dip well below 4.5, which I think is something that hasn't happened very often. We see clients who are thinking about locking in higher yields longer term, which, depending on circumstances, we're obviously always talking about the tax consequences of doing that. You got to make sure that it works for your strategy. But the other interesting phenomenon that we experience is when you talk to clients about higher yields, and then you go back and say, hey, but you're giving up the opportunity with inflation and really good days like the market is experiencing today to really see some appreciation and growth. A lot of them are still interested in being exposed to the market. So we've obviously pulled back. We haven't changed asset allocations dramatically, but a lot of our clients are still interested in being engaged in the market, particularly with the kind of earnings strength that a lot of the market is beginning to show as we come out of an earnings recession. They still want to be involved in the market, and so we're happy to accommodate them.
Okay, certainly some good takeaways there. Some new optimism coming through. Dan Griffith, Huntington Private Bank Director of Wealth Strategy. Good to talk to you today.
Thank you.